You ever see a company put out what looks like great news, only to watch its stock just get completely demolished? Well, that's exactly the puzzle we're looking at today with GitLab, and we are going to get to the bottom of it. So, let's set the scene. The date is December 3rd, 2025. This is what happened to GitLab stock. In just one day, it plunged 13.3%. I mean, that's a huge chunk of its value, gone in a flash. For anyone holding the stock, it was a really rough day. And this is where things get, well, weird. On the one hand, GitLab comes out and says, hey, we beat Wall Street's expectations. That should be a party, right? Champagne corks popping. But the market's reaction was, to put it mildly, brutal. It's a classic Wall Street mystery. So that brings us to the real question here. What's going on? What did the big investors on Wall Street see that the rest of us might have missed just reading the headlines? It's time to put on our detective hats, because there are clues hiding just beneath the surface. Okay, so here's our game plan. We're going to tackle the paradox itself, look at the most obvious clue first, then really dive deep into the financials, uncover the risks that are keeping management up at night, lay out the bull versus the bear case, and then it's up to you to decide. In any good mystery, you always start with the prime suspect. And in this case, the first clue, the most obvious one, came directly from GitLab itself, specifically from their forecast for the future. The media jumped all over this. As you can see here, GitLab's guidance, which is just their best guess for future sales, came in a little bit lighter than what the analysts were hoping for. Now, for a high-growth company like GitLab, the future is everything. So even a tiny crack in that growth story can really spook people. But here's the thing. A slight miss on guidance doesn't usually cause a stock to implode by over 13%. That kind of massive drop suggests that this was just the tip of the iceberg, maybe confirming a deeper fear that investors already had. To get the real story, we have to go beyond the headlines and look at the source, the company's official 10K report. All right, now we get to the really good stuff. We're cracking open the official evidence file, the 10K. And what we find in the numbers is a real tale of two completely different stories. So first, let's talk about the good story. And man, it is good. Check this out. Revenue grew by a massive 31% for the year. That is fantastic growth. It tells you that customers are flocking to their product and the business is firing on all cylinders. From this angle, GitLab looks like an absolute beast. And the good news doesn't stop there. Not only were sales way up, but they got incredibly close to actually being profitable. Think about that. Their net loss went from over $400 million all the way down to just $9 million. This is exactly what you want to see. So, the plot thickens, right? Why on earth would anyone be selling this stock? And here's the twist. While the company looked more profitable on paper, the actual cash that the business was generating, well, that went in the wrong direction, big time. They went from generating a positive $35 million in cash to burning through $64 million. And that, my friends, is a huge red flag. A company can't burn cash forever. This is the clue that tells us something is wrong under the hood. So the big question is, why are they burning through so much cash? To figure that out, we're going to head to my favorite part of any annual report. It's the section called Risk Factors, where companies are legally required to tell you everything that could possibly go wrong. First off, the competition is absolutely brutal. GitLab is not just fighting off a few small startups. They are in the ring with some of the biggest, baddest companies in all of tech. We're talking about Microsoft, which owns GitHub, and Atlassian. Going toe-to-toe with giants like that costs a ton of cash. And here we get a pretty clear idea of where a lot of that cash is probably going. This quote from their own report is super revealing. The big race to cram AI into every product is not cheap. They're telling us, flat out, that the high cost of computing could really hurt their profits and, importantly, their cash flow. And to make the whole AI thing even messier, they're dealing with this major legal headache. They're facing a class action lawsuit that basically alleges they hyped up their AI features and their ability to make money from them. A lawsuit like this is expensive, it's a huge distraction, and it casts a dark cloud over their entire AI strategy. And there's one more piece to the puzzle. Part of what makes GitLab so popular is its open source foundation. But they admit that this also makes them vulnerable. It makes it easier for other people to basically copy their work and even sell it without permission, which is a constant threat they have to deal with.
Okay, so we've looked at all the evidence. We've seen the good headlines, the weak guidance, and the worrying details buried deep in the financial reports. Now it's time to bring it all together and lay out the two competing theories of the case.
So it really comes down to this, the bull versus the bear. The bulls, the optimists, are laser focused on that incredible 31% growth and the fact that they're so close to profitability. They see a leading company with a loyal following, and they think this stock drop is a huge buying opportunity. But the bears, the pessimists, they see a totally different picture. They're pointing to that weak guidance, the negative cash flow, the giant competitors, and all the cost and legal drama around their AI strategy. They see a lot of warning signs. So there you have it. We've investigated the paradox, we've followed the clues, we've uncovered the risks hiding in plain sight. All the evidence is now on the table. And that means it's time for the final verdict. And that leaves us with the ultimate question for you. After this huge drop, do you see GitLab as an undervalued innovator that just hit a temporary speed bump? Or do you see a company whose fantastic growth might be hiding some very real, very fundamental challenges? The evidence is in. The verdict is yours.